Zoom Video Communications came out with earnings last night, and the market seems to like what it saw. But does this mean that the company is back to growth mode? Well, not quite. My name is Brian Stoffel. We'll take the next 10 minutes figuring out what this means for Zoom shareholders. And I want to thank CommonStock for sponsoring today's video. Brian Feroldi and I have put Zoom Video Communications in our portfolio that we run over on CommonStock. You can click on the show notes below to see a printout of our reasoning for what we think about this quarter and leave a comment there, but more on them in just a minute. So let's look at the company's fourth quarter of fiscal 2023. On the top line, revenue growth was just 4% per year, but that came in ahead of expectations from management and Wall Street. Earnings per share actually fell 5% to $1.22 on an adjusted basis, but that was way ahead of both Wall Street's estimates and management's guidance. Now, looking at margins, they expanded on a gross basis but contracted somewhat on operating and net basis. But make no mistake, at least on a non-GAAP basis, these types of margins are the envy of any publicly traded company. Free cash flow dipped just ever so slightly by $6 million. Net income, it was the same story, although the absolute value was much higher, and the balance sheet remains in stellar shape. $5.4 billion in cash, absolutely zero long-term debt. Now, it's important to understand the dynamics at play here. When Zoom Video Communications started, it was supposed to only serve enterprise customers, but the pandemic changed that, and a lot of consumers jumped on. Those consumers are leaving, but the enterprise customers are the story now, as it was intended to be, and those enterprise customers were up 12% from the same time last year to 213,000. The number of customers contributing at least $100,000 in revenue over the last year was up 27% to about 3,500 customers. Now, this is important. The net dollar expansion rate for those enterprise customers was 115%. Now, that's down overall, but what this means is that Zoom is not only holding on to its enterprise customers, but is getting them to spend, on average, 15% more per year. That not only widens the moat in terms of switching costs, but shows that they can offer products that customers are willing to use. Now, to those consumer customers, people like you and I that you use to communicate with family and friends, the churn rate is at 3.4%. That was down from the same time last year, up slightly from the previous quarter, although that was expected as this does have some seasonality to it. Now, in terms of management commentary, they said that the enterprise business, and remember, that's the important part, grew 18% year over year and represented 57% of total revenue. They expect those enterprise customers to continue ramping up to make up the lion's share of this company's revenue moving forward. This is a big mental model that investors need to wrap their heads around. This won't be consumer driven. This will be enterprise driven moving forward. And that online monthly churn, as we covered, did decrease from 3.8 to 3.4%. Now, it's also important to look at RPO, which is remaining performance obligations. Overall, it grew 30%, much faster than the 4% growth overall that we saw. 16% of that growth is going to be recognized within the next year, 53% of it beyond 1 year. What does that mean? It means that customers are signing larger contracts that last longer than a year. Overall, that's great news because the focus is now on the enterprises. If we just look down the income statement on a non-GAAP basis, we see that gross profit actually expanded. We saw that when we looked at margins. That's a great sign. Now, R&D was actually up as a percentage of revenue. That might be alarming, but management isn't shying away from saying that it will be investing in its product portfolio. That is a top priority. If you're a long-term shareholder, that's actually not terrible news, as the number of products that Zoom offers has expanded quite a bit since the company went public, and the continued expansion there is an important part of the investing thesis. Now, sales and marketing also increased as an percentage of revenue, and the company says that it is making some restructuring to optimize their go-to-market strategy, so hopefully that can come down a little bit moving forward. G&A moved down as a percentage of overall revenue. We like to see that. Now, it's worth noting that stock-based compensation was pretty much bonkers for this quarter, moving from $161 million last year to $518 million this year. They said some of those expenses are going to be sunsetted, so they're not not as big of a deal moving forward, but that's still a lot of stock-based compensation. It is, however, worth noting that the company was able to basically use all of its cash flow that it got over the previous year and use that on share buybacks. Because of that, $1 billion on share buybacks, the diluted share count actually fell by 4% despite that stock-based compensation. So it wasn't all in all a loss for shareholders. Looking forward, there is a similar theme here, which is that revenue is pretty much grinding to a halt. Only 1% revenue growth at the midpoint versus what Wall Street was hoping for is 4%. However, on the bottom line, the midpoint of earnings guidance, although it's lower than it was in the year ago quarter, is ahead of Wall Street's estimates. And we see those same dynamics at play on the year-long basis, muted revenue growth, but much higher earnings per share than Wall Street was expecting. So what should we watch moving forward? Again, the most important thing is that enterprise dollar-based net retention, or the enterprise total number of customers, or the $100,000 customers. That is the future for Zoom. It is not the consumers like you and I. Second, operating margins. We want to see those sales and marketing as a percentage of revenue come down. Third, you can keep an eye on online churn because it still does affect the company, even though the enterprise is the most important part, and that's growing at a modest pace. The online churn is what's pulling down the overall numbers. And fourth, keep an eye on free cash flow. Overall, we think that the moat direction here is stable, if not widening. And the thesis to me is now on track because it is clear that they are getting traction with enterprise, and those online consumers will become less and less important over time. This scores very well for Brian Feroldi's quality score. It scores a 10.5 on my anti-fragile score. But let's go ahead and take a look at the valuation, and it's important to visualize where Zoom is in its life cycle. It is, we think, somewhere between stage 4 and even stage 5 for such a small company, because it did return $1 billion to shareholders during the previous year. So the income statement is pretty much optimized for all of these things, which means there's a lot of different metrics we can look at. On a price to sales ratio, Zoom's trading for about 5 times sales. Gross profit is clocking in at about $3.3 billion, which means it has a price to gross profit of 7. It seems pretty reasonable to me, but look at this. PE ratio currently trading at 32 times trailing earnings. That's on a non-GAAP basis. Forward basis, just 20 times earnings. And the price to free cash flow is just 19 times free cash flow. Now, I even did a very simple reverse discounted cash flow model. And when I did, today's stock price implies just 3% growth. Just 3% growth is assumed in Zoom stock price for the free cash flow over the next 10 years per year. That seems very reasonable to me. And so because of that, I've changed how I do my own framework, where I ask myself, how reasonable is that assumed growth rate? And for me, it is very reasonable. So I'll add even an extra 1.5 on there, bringing this all the way to a 12, landing it in that anti-fragile category. This is a change from how I've done things in the past. So that's the overall story with what's going on with Zoom video communications. Again, the most important thing to remember here is that the consumers are coming down, enterprise is coming up, and man, this does have an attractive valuation. So what do you think about this? Well, head on over to CommonStock by clicking on the link below and leave a comment there to let us know what you think. If you leave the most insightful comment that we choose, CommonStock will pay $100 to whoever that person is. We'll check back in on this one in 90 days. Until then, Brian out.